Alright, madam. So in the last class, we had seen how we do the double entry and how we record in the T accounts the phenomena of provision for doubtful debts and bad debts. So one thing now we have to realize that how would we get this topic tested in the final exam? It can be tested in two ways. First of all, you could be given a scenario like this, the way we have practiced, and you could be asked to make the provision for doubtful debt account, or you could be asked to prepare a bad debt account. The other way, and the way in which it's most likely going to be tested, is that you would be given a trial balance, and at the end of the trial balance you would be given certain adjustments. So these are the year end adjustments. For example, you would be given the balance of closing inventory, which we have already seen. The amount of closing inventory is always given outside the trial balance towards the end as remaining adjustments or closing entries or closing additional information. So the same way, we could be given the information about provision for doubtful debts, and then incorporating that information in the financial statements. That is something that we'll have to learn. So if we are given the final adjustment about the business, how we incorporate that in the trial balance, and what effect would it have on the total preparation of the financial statements. So that's what we are going to learn now. So here you have this question in which we have a trial balance given, and below the trial balance we are given some additional information, and that information, okay, so the best way to incorporate this additional information is, uh, first you adjust the trial balance with this information, and once you have the adjusted trial balance, then you start preparing the financial statements. Acha ji, we are usually required to prepare two financial statements out of it, the statement of financial position and the income statement. You can prepare them simultaneously. You can prepare the income statement first. But the thing about the adjustments that you have to remember is that each at this trial balance that we have, it is showing a sum that is equal of debit and credit. So that means that the double entry rule so far has not been violated. So far, the financial statements, whatever records the entity is keeping, they are keeping them in the correct form. So now, when we incorporate these adjustments, each adjustment should also give rise to a double entry, whereby the financial statements, they will not be disturbed. Okay, so as the result of each, so for example, we are given these 5 or 7 points as additional information. As a result of each point, there could be a double entry. What you have to remember is that whatever adjustment you seem to see over here, each adjustment, it would have a double impact, a debit impact and an equal credit impact. Okay, so how about you read this complete question first, and then we can, in a minute or two, when you have read the entire thing, then we can go on and solve it. And one by one, we would now adjust these transactions in the trial balance. Okay, so first of all, the effect of this closing inventory, once it would appear on the credit side and once it would appear on the debit side. The credit side, when it appears, it reduces the cost of goods sold, or it increases the profit. And the debit side, when it appears in the financial statements, it goes to the statement of financial position. So I can write over here, so for example, inventory 5,000 and 5,000. Acha ji, the next it says sales includes goods sent on sale or return to a customer, not yet identified acceptance of the goods. Okay, so in this sales, what has happened is that we have sold goods to someone, and we have told that person that, here, take these goods. If they get sold, keep your commission and send us the remaining amount. If they do not get sold, then perhaps after some period you could return it, or some arrangement. So the thing to remember for such transactions is, when you give goods to someone on sale or return basis, then such things sent to this person, they do not count as revenue until those things, they get sold by that person. So let's take a tangible example. Let's say you sell shoes. Okay, and a friend of yours, she also has a shop, and she once visits you and says that these are really nice pairs of shoes that you're selling. Let me take a few pairs with me, and if they get sold, I would keep certain amount of commission, and the rest I'd give you back, as since these were your shoes. So that inventory, as long as it is lying with that person, it would still be counted as your inventory. The proof of that is, if something happens to those shoes while they were lying at her shop or at her place, that would be your loss, not hers. Okay, so these items, they're still your inventory until they get sold by that person. At that amount, at that point of time, you're allowed to record sales. Right now, you aren't. So what I do is, I would remove this amount from sales and also from debtors. So from sales, how much is the amount? Minus 4,000. And from debtors, I'll make the adjustment. Debtors. Where are debtors? Trade receivables. How much? 19,800 minus 4,000. Okay. Hmm. So the amount of sales I would remove, and the amount of cost I would add to the inventory or cost of goods sold. Also to purchases. So purchases, how much? 3,000. And closing inventory. Now the thing is, have they been already included in the closing inventory or not? Have these been already included in the closing inventory or not? It's a small mistake. Instead of adding it to the purchases, I can simply add it to the 3,000 balance of inventory, both in the income statement and the statement of financial position. This 3,000, it would get added. Okay, you don't understand. Actually, the first thing we mentioned is that since these goods, they haven't been sold by them, so they should be deducted from the sales and debtors balance. Do you understand that part? And if they haven't been sold, they're also our inventory, so they should be added to the inventory balance. So where is the inventory balance right now? This 5,000 and this 5,000. Closing inventory overall, it is 3,000 more. And the amount that I would add to the closing inventory, should it be 3,000 or should it be 4,000? 3,000, because that's the cost. All the inventory I value at lower of cost or NRV. NRV you don't understand right now, but that's fine. That's something perhaps we'll discuss later. But as of now, given the choice between the selling price and the cost, we would value the inventory at cost. So the amount that has to be added in the closing inventory is the cost. So I would add 3,000 over here and 3,000 over here. Okay. In fact, I'm adding this 3,000 to this 5,000, and this 5,000 eventually, since it's going to the trial balance, that's why I added it over there. Understood? Acha, trade receivables include debts totaling 1,700, which we know would be irrecoverable. So the double entry for this would be bad debt expense debit and trade receivables credit. The double entry to write off bad debts, right? We have discussed that before. Acha ji. So we'll have irrecoverable debts, irrecoverable debts debit, or bad debts debit by how much? By 1,700. And trade receivables credit. So the effect of crediting the trade receivables would be that the balance would reduce by 1,700. Yes. So again, double entry, the trial balance, it would stay, the balance, it would stay the same for both debits and credits because I'm adding 1700 in the debit column and I'm also subtracting 1700 from the debit column. Okay. Okay, the provision for doubtful debt is to be adjusted to include a provision of 3100 and a general provision of 5%. Acha ji. So for this, we can quickly make the account of provision for doubtful debts. What it would look like is we already have a balance of 800 in the provision for doubtful debts account to begin with, right? So if I give heading over here, um, provision for doubtful debts. Okay, the existing provision is how much? The existing provision is it 800 or 820? 800. Okay. So my brought down is 800. And what's my closing balance going to be? There is a person for which, or there is a certain number of people for which I need to make a specific provision of 1300 and a general provision of 5%. So the carried down amount would be 3100 plus now 5% of which balance? 5% of 19,800 or 5% of 19,800 minus 4,000 or 5% of which amount? When it says the general provision of 5%, to what amount should I apply this 5%? Yes, madam. So, why not to 19,800? Because first of all, 19,800 includes an amount of 4,000. These are the things which we haven't sold yet, so this amount it needs to be removed. Okay. Then this 1,700, these are the people who I know that they're not going to pay me. I'm just writing off their debt from my book. So they are also not debtors. What remains is the number of actual debtors, and on those debtors, I need to provide this provision of 5%. Okay. So if I calculate that, or just a second, just a second. Opening balance is 800. Specific provision. Nahin, am I making a mistake over here? Okay, let's do it this way. If I have 19,800 minus 4,000 minus 1,700, that gives me 14,100. If I calculate 0.05 of this, it gives me 705. Did I do it right? 19,800 minus 4,000 minus 1,700. 1,700 के राइट ऑफ करना था ना. Just a second. Hmm. Hmm. If I no. So what I'll have to do is I'll also have to deduct the amount. Okay. Reset. Okay. So the way we would handle this specific provision is that there are some people. Okay, so this is the amount of debtors that I have, 19,800. Out of these 19,800, 4,000, they're not debtors at all. I erroneously recorded that still, so I deducted that. Then 1,700, they also, they also, they're also not my debtors. I've just written off their debt from my book. Okay, and then there are 3,100 worth debtors for whom I am going to make a specific provision that these people I'm especially doubtful that they're not going to pay me. I have a general policy of maintaining a 5% balance, but these people, they're too suspicious. I'm not writing off their debt, I'm just declaring it to be doubtful. Okay, so if I deduct this 3100 as well from this, so for this 3100, what's the double entry that I'm going to pass? The double entry would be provision for doubtful debt debit, provision for doubtful debt account debit by how much? By 3100. And debtors account credit or trade receivables account credit by 3100. This is how I record a specific provision. Okay, so for these people I have recorded a specific provision. So the debtors that remain, I would even deduct this 3100 from it. Now what's the balance? So let's see, 19,800 minus 4,000 minus 1,700 minus 3,100. Remaining is 11,000, and on that I apply 5%. So the closing balance, the carried down balance is 550. Carried down is 550. And it is always a good idea to show your calculation that on what amount have you applied this percentage. Or you can show an asterisk over here. And over here you can show the complete calculation. 19,800 minus 1,700 minus 4,000 minus 3,100. That leaves you with 11,000. And on that you applied 5%, which is equal to 550. So here's the calculation for this 550. Okay. Now if I close this account, it would show me 3,650, and this side it would also show me 3,650. So it means the amount that gets taken to the profit loss account is 3650 minus 800, 2850. Okay, I can tell that this is the balancing figure. Acha. So the double entry for this would be one entry we made. How much? One entry we made debtors credit, and over here I can write provision for doubtful debts. I reduced by 3,100, so here I will first write 3,100, and the other double entry would be to manage this balance. So this carried down balance, it should be 550, right? What's the difference between 550 and 800? 250. So I would debit the provision for doubtful debt account, which means I am reducing this account by 250, and I would also reduce this 3,100 by 250. Okay, so now the balance that gets charged to the profit loss account in lieu of provision for doubtful debt, it would be 2850, exactly the amount that we calculated over here. Make sense? Acha, the next transaction, it says number 5, the following expenses are to be accrued: wages 400, electricity 360, and telephone 100. So do we have already heads for these? Yes, we have. Acha, for wages, how much is to be accrued? 400. So for wages, I'll add 400. What's accrued expense? Have we discussed that before? Okay. And then there is electricity. How much is electricity? 360. So to the electricity expense 1027, I add 360. And then there is telephone 100. So to this 900, I add 100. But this would disturb the trial balance. I've added something on the debit side that would be balanced by accrued expenses, which is a liability. So all these expenses, they are accrued. We have incurred these expenses but not yet paid for them. So the sum of these three is 400 plus 360 plus 100, 860, right? So I would write accrued expenses as 860, and this is a current liability of the business. So it would appear in the statement of financial position under the heading current liabilities, this amount of 860. Okay, so entry number 5 also understood. Then for rent, I am told that 1600 has been prepaid. So this amount 7600 which appears out of this 1600 is prepaid. It belongs to the next period. So I will deduct from this one 1600 because this is not the expense for current year, so it needs to be removed from here. And to the debit side, I will add a balance. How much? I will write prepaid expenses. Prepaid expenses. And how much are my prepaid expenses? They are 1600. So let me move this calculation down so that we do not confuse it with the trial balance. Okay, ji. Let me also move this T account downwards. Acha ji. And in the end, it says that depreciation is to be provided on the following basis. We have already discussed the chapter of depreciation or not yet? Not yet. Acha, I'll for this question, I'll just tell you. Why was I under the assumption? Acha, for the book which we are following, they discuss the doubtful debt portion first and then the non-current assets. So here the questions they are combined. Okay, no problem, no problem, no problem. For this one, I'll just tell you that what are the depreciation expense. So for example, do we already have over here the depreciation expenses? No, we don't. Okay, okay. So depreciation expense provided on the following basis: leasehold land 5% straight line. Okay, where is leasehold land? Premises at cost. ठीक है. 70,000 5% is how much? That is 3,500. So 3,500 for this. 3,500 and 25% reducing balance for delivery vans. Delivery vans at cost 18,000. Where is the provision depreciation is 3,600, right? So it would be 18,000 minus 3,600 into 25%. So 18,000 minus 3,600 into 0.25. 3,600 it is. 18,000 minus 3,600 into 0.25, which is 3,600. And for the office furniture as well, it would be a straight line. So where is office furniture? Straight line. What's the percentage? 10%. So 3,000 10% would be 300. So 300 for office furniture. So total depreciation expense is 3600 plus 300, 3900 plus 3500, 7400. So I will write in the debit column depreciation expense, depreciation expense. Okay, and the depreciation expense, it comes out 7400. How? 300 plus 3600 plus 3500. Acha ji, as for the provision, so the debit side again, its sum exceeds that of the credit side. So let's add these values to the credit side as well. For freehold land, we calculated it to be 3500, 5%, 7000, 3500. ठीक है. So I add 3500 to this 5000, and then there is office for delivery vans. For delivery vans, it was how much? 3600? नहीं, हाँ जी, 3600 for the delivery vans. So to the already existing 3600, I add 3600. And as for furniture, it is 300. So to this 1500, I will add 300. Okay, so now I have incorporated all the adjustments in the trial balance, and what remains to be done is to prepare the income statement and statement of financial position out of it. For the items that you are encountering for the first time, so for example, this irrecoverable debt or bad debt written off, you can write it as bad debt written off, bad debt written off, or simply bad debt. This would go in your operating expenses in the income statement. This provision for doubtful debt, this is also the increase in provision, so this would go also in the operating expenses. Prepaid expenses, I've told you, these are your current assets, they would be shown in the current assets. The depreciation expense, this would also go in operating expenses. As for the provision of depreciation for each item, the land, the delivery vans, and the office furniture. So the way it would be presented is that, as of now, to make things easy, later I'll give you a more sophisticated pattern for it. But for now, uh, from the cost, you will deduct the total accumulated depreciation. From the cost, you deduct the total accumulated depreciation, provision for depreciation, and that is the amount of land. That is the net book value of land, and it's the net book value that gets presented in the statement of financial position. You do the same for delivery vans or delivery vehicles. From the cost, you will deduct the accumulated depreciation, and that would be the net book value, which would go to the statement of financial position. The same for office furniture as well. Okay, so